So greetings to all of you and welcome to our discussion session for income taxes, where we're going to take you through some of the principles that apply to income taxes as prescribed by this International Accounting Standard 12. All right, my name is Thomas and I have the pleasure of presenting this information to you. All right, so this is the number that where we're reachable should you want more information. So we want to introduce you at third level to the subject matter of income taxes. So this is going to cover concepts such as the calculation of current tax, deferred tax, as well as the disclosure requirements for income taxes. So this is specifically for UNISA students and at large those students in South Africa who are doing similar modules. But of course, you can find the content helpful from any perspective as long as you're studying income taxes from the perspective of financial accounting. Because sometimes you do income taxes from the subject matter of taxation, and then it's going to be slightly different. So to help us get into the concepts, I have chosen a question which is one of the previous questions from UNISA. All right. And I'm going to explain to you as we go, how do we apply taxation, income tax principles in this particular case. All right, so we have the information, and as we go, I'm going to dissect the information for you, and then eventually we're going to start answering the question. So the question tells us that we have an entity, and the year end of the entity is 31 December 2020. All right, so that's a very simple year because it started on 1 January 2020. The reporting period is very important because we have to account for transactions correctly in the reporting period that we're dealing with. So the reporting period is from 1 January 2020 to 31 December 2020. That's our financial year. And for that financial year, we have this is the profit before tax. Right. So when you deal with questions of this nature, especially from the University of South Africa perspective, you normally get given an accounting profit, a figure like this one, which is also referred to as profit before tax. So we have accounting profit, which is determined according to accounting standards, the IFRS and the IAS, the accounting standards. Then sometimes you're given transactions that you have to look at and adjust the accounting profit. So this might not be the correct accounting profit. Then you might need to adjust that amount, taking into account perhaps there are errors. So you have to correct the errors there. Perhaps there are any omissions, like some transactions have been omitted. Then you need to read through the information and look for any omissions, adjust those omissions there. You could also have a change in estimate, such as a change in the residual value or the useful life of a depreciable asset. You could also have a change in accounting policy, which is going to affect the profit before tax. Okay, so you can also have events after the reporting period, and these are adjusting events, so that we might have to come back and adjust our profit before tax. So whenever you have this information, remember you might need to make accounting adjustments to the profit before tax figure that is presented. So what does that mean? That means it's we're still doing the accounting side of things, because after doing the accounting side of things, we might have to do the taxation side. So when we correct the profit before tax, we are still looking at accounting. We are not yet at a position to make the taxation adjustments. Because remember that your income tax is calculated not on profit before tax, all right, but is calculated based on the taxable amount. Okay, and so what we do when we do the calculation of current tax, disclosure, and deferred tax, we start from profit before tax. Then we make adjustments to this profit before tax until we come to taxable income. Once we determine the taxable income, then we apply the tax rate that is applicable to the question. So we would think our questions would contain 27%. So this profit before tax adjustment, this would be the corrected profit before tax. So the process of correcting this has nothing to do with the adjustment for taxable income. When we have to correct accounting profit, we are using accounting standards, which is the IFRS and the International Accounting Standards. So many students get confused there, but we will demonstrate to you how to pay attention to that so you do not lose unnecessary marks. So let us go through this and apply the principles as we go. All right, so you see there that we have income, and we are told that we have profit before tax, and we are told that it includes the following items. So this is income, this is a foreign income, and so generally you should expect your foreign income to be non-taxable in South Africa. So which means that it's going to be exempt, and if it is exempt, then we need to adjust it because it's an exempt difference. So we need to adjust it so that we can get taxable income. Remember, for us to get taxable income, we're going to adjust our profit before tax. For those things that the adjustment is going to follow the rules of SARS, or the revenue collector. Right, so dividends. So in most cases, your foreign income, right? We're still talking about foreign income. It's going to be not taxable. So it's going to be an exempt difference, and all exempt differences are reconciling items. So where we have to do a disclosure of the income tax expense, we also disclose the tax rate reconciliation. It's a requirement of EAS to relate. They want that reconciliation to demonstrate the relationship between profit before tax and the income tax expense. That's the tax rate reconciliation. Then dividends received are also exempt from income tax. And because they are exempt from income tax, they already have been included in this amount. So if we want to adjust the correct profit before tax amount, we have to remember that dividends have been included in there. So we need to reverse them because they are in exempt differences. We do not want to consider them when we want to determine the taxable income. We want to remove the dividends from profit before tax because they are exempt. We also remove foreign income. So dividends also are going to be a reconciling item. All right, we also will explain further what we mean by a reconciling item. All right. Then we come to our expenses. Right, so we have our expenses. All right, so that was exempt differences. Then now exempt differences, you know what, those items that have been included in the profit before tax. All right, so they were included, they affected the amount for profit before tax. But now, because the profit before tax is our starting point for the calculation of taxable income, all right, there are certain items that have been included in the profit before tax, which are not tax deductible or which are not taxable. All right, so we have to exclude them. We have to reverse their effect. We have to remove them. So those items which are non-deductible or non-taxable are called exempt differences, and we have to exclude them. Then we also, so these items could be income items or expense items. For example, this depreciation building here, if you come to information under 2, it tells you that the depreciation building, all right, SARS tells you that the South Africa Revenue Service does not allow a tax allowance. So on the administration building, okay. And so what that means is that at the depreciation, because there's no tax allowance that is provided, the depreciation, the accounting depreciation that applies to the buildings is going to be a tax exempt expense. It's going to be an exempt difference in the sense that it was included in the profit before tax, but SARS does not want that. All right, does not accept that. So we have to reverse that because there's no tax allowance allowed in this particular case. All right, so that's going to also to be a tax exempt item or an exempt difference. Then we have some differences which we refer to as temporary differences. Temporary differences are different from exempt differences. So we said exempt differences are also referred to as permanent differences, all right? Because the revenue receiver does not tax those items, that does not allow for deduction of those items. So the difference between profit before tax and taxable income, that is permanent. You cannot expect that to be reconciled later. Whereas in some cases, the amounts that we deduct and the amounts that SARS wants to deduct are different, all right? But it's actually taxable or deductible. It's an issue of the amount and the time. SARS may want us to pay tax now, but according to accounting, we may have to recognize that element in the following period. All right. So it's an issue of timing. SARS might say, deduct it now, all right, but we wanted to deduct it later. So it's an issue of timing. We both agree that this item is deductible, this item is taxable, but the difference is when is that going to happen? All right, so that's going to be a temporary difference. It's not a permanent difference because it's a difference that arises as a result of timing. When should this be deducted? Whereas exempt differences are permanent because SARS says you have included them in your accounting profit, but you will never be allowed to include them in your taxable income. So the difference between profit before tax and taxable income is going to be permanent based as a result of that. Okay, so I'm trying to explain the English behind exempt permanent differences and temporary differences. But I'm also trying not to be too technical in the terminology because this is supposed to be an introductory session for you. Okay, so let's go to this. So we have a depreciation for drones. Then we have credit losses. Then we have this. So these fines paid to Metro are not tax deductible. So they are included. They have been included here, right, in the profit before tax. But remember that for us to deduct something according to the gross deduction formula, all right, if you remember the gross deduction formula, it says the expenditure should be in the production of income. So a fine is not deductible because it's not in the production of income, right? So therefore, it's an exempt difference because it's permanently not allowed to be included in profit before tax, whether today or tomorrow. It's not allowed. So it's going to be a permanent difference. All permanent differences, like I said, are reconciling items. All right. All permanent differences, all exempt differences are reconciling items. So let's go to the information that we get So we have drones there, and we have depreciation of 45,000. Then credit losses 50,000. Then offsite data backup services, then is 12,000. All right, so we've gone to the foreign income received from Namibia, and we are told that this is not taxable in South Africa. So we always have to read the additional information. So it's not taxable in South Africa, but in Namibia, it was taxed at 15%. All right. Okay, so we know that already this is an exempt difference. Also, this is an exempt difference as well. Then the drones, we are told that this is on the 30th of June last year, right? We have 90,000 each of the 3 drones were bought for 90,000. So basically that gives you 270,000 cost, right? And remember, when you want to calculate depreciation, this is very important. You start calculating depreciation when an asset is available for use. So you look for the date that an asset is available for use, not necessarily the date it was brought into use, but the date it became available for use. Then you start calculating your depreciation. Then on the date it was brought into use, then you can start calculating tax allowances or wear and tear, where the asset qualifies for that wear and tear allowance. So according to SARS, we can deduct allowances when the asset is brought into use. According to accounting standards, we begin our calculation of depreciation when an asset is available for use as intended by management. All right, we don't have to wait until the asset is brought into use. And we are told that the useful life is 4 years. Okay, so here's the story now which we need to pay attention to. The South Africa Revenue Service allows a tax allowance over 5 years, and there we're going to calculate depreciation over 4 years, but SARS is going to calculate their wear and tear over 5 years. So as you can see there's going to be a timing difference, because you're going to calculate depreciation this year, SARS is going to calculate its own tax depreciation this year. Then the amounts are going to be temporarily different. So that's a temporary difference as a matter of time. This is 4 years, this is 5 years. Right now, we say that our year is 31 December 2020. So at the beginning of this current year, one of the drones was sold. So here's the details of the sale, all right? So it was sold, cost price is 90,000, selling price 95, carrying amount on this particular date is that amount. Remember, it was sold on 2 January 2020, like 2 days later after the previous year end. So basically it's we don't have to calculate the depreciation for the 2 days because that's insignificant, that's not material. Then the tax based on 31 December was that amount, right? And then the question says that the sale of the above drone has not been recorded yet in the accounting records. Now, if the sale of if there is a sale of an property PPE item, we have to look for 3 things. So whenever there is a sale of a PPE item, there are 3 things that we as students should pay attention to. All right. The first thing that you need to pay attention to, especially if that has not been recorded. All right. So we need to check first if it has been recorded correctly or not. And so these are the areas that we need to pay attention to. The first thing is the selling price. Is it above the cost price? So the difference between the selling price and the cost, the original cost, not the carrying amount, the difference between the selling price and the cost price constitutes a capital gain. And the capital gain for taxation purposes, 20% of the capital gain is not taxable. Therefore, 20% of the capital profits is an exempt difference. So the first thing we check, if there's a disposal of a PPE item, we need to check, number one, the selling price against the cost price. If the selling price is above the cost price, then we remember that there is capital gains. And 20% of that capital gains is going to be exempt. Because it's going to be exempt, it's also going to be a reconciling item in the tax rate reconciliation. That's consideration number one. The second consideration, we have to consider if there is any profit or loss on disposal. And to calculate the profit or loss on disposal, we're going to say the selling price minus the carrying amount on the date of sale, right? And if you want to determine here, the selling price is 95,000 and the carrying amount is 78750, right? So that means that we have a profit that was made of 95,000 less 78750. So a profit was made of 16,250. This whole profit should be included, right, in the income statement as other income. And if we are going to do the profit before tax note, this should be disclosed as profit from the disposal of a PPE item. Right, so two things so far, the capital gains and the profit on disposal. Then number three, which is quite important and can be very complicated, we need to check, because the accountant, let's look here. Let's look at what the statement says here. Let's look at what happened to the accountant. All right, so we are told that the sale of the above drawn has not been recorded yet. So what could happen is, because the accountant hasn't recorded the sale, the accountant could have believed that this asset is still there because it was not removed from the asset register. So what could happen is the accountant could calculate depreciation for the year, which would be 90,000, right, over 4 years, which is equal to 22,500. So this would have been included in the income statement by error because these have been sold and the accountant was not aware. So we need to know if the accountant made a mistake, right, and included those which he shouldn't have included. So we're going to recalculate the depreciation. The correct depreciation is for the two drones, right? Each 90,000 because the third one has been sold. We divide that by 4 years, right? So the correct depreciation should be 45,000. So if our depreciation is actually has an extra 22,500, so that it will be 67,500. We will remember that this is wrongfully included. We have to reverse it by adding it back. So we can go there and check our depreciation for the drones, and we can see that it's 45,000. Therefore, the wrong depreciation was not included. That's what it means. So the third aspect is look at the wrong depreciation. All right. So let's say that this asset was used from the 1st of January and was disposed on the 30th of June. All right. So which means that if it was not removed from if it was not de-recognized, then the accountant would have calculated the depreciation for the full year, whereas we only want depreciation from January up to date of disposal. So when reversing depreciation, we only reverse the excess depreciation, the wrong one, which is from July up to December. Then that's the one we are going to reverse. So these are the three things that you need to pay attention to. Okay. First of all, has it been recorded? Has it been recorded properly? So you check those things. Okay, so as you can see here, our capital profit. Let me just clear that a bit so that you guys can be happy. All right, so if you look there, then our capital profit is going to be our capital profit is the selling price minus cost. It's going to be 5,000. And know that 20% of that is going to be tax exempt. It's going to be an exempt difference, right? Now we come to allowance for credit losses. Now allowance for credit losses are going to reduce our what is that called? Our trade receivables. Okay, so last year the allowance was 150. Current year the allowance is 200. All right. And so we are told that SARS only accepts 25% of the allowance for credit losses. Okay. So we know that there's going to be a difference in our tax base between the trade receivables, the carrying amount of the trade receivables, right, and the tax base of the trade receivables, right? The tax base, because SARS is saying, okay, we have our trade receivables control, then we subtract 25%, right? So our trade receivables, according to SARS, is going to be higher than our trade receivables according to our carrying amount. So we have a case where the carrying amount of an asset is less than the tax base of an asset. We will cover that a little bit as we go. But then this is the situation that we find ourselves in. All right, so I think that is covered. Then this issue one is a very simple and straightforward issue. So we thought that they entered into a contract and they first paid an annual installment. So that's an annual installment, right? For the whole year to cover until October next year. So for this current year, it's only November and December, those 2 months. Then the other 10 months is a prepayment. But this was the full amount was recorded as an expense. So we have to do an adjustment there. So what are we adjusting? We are adjusting the profit before tax to say there is some aspects that are missing. So this will be an adjustment of an error. This is going to be an adjustment of an omission, right? Because this is omitted. It's not yet recorded, right? So where are we? We are also told that the tax rate changed from 29% to 28%. All right, and the capital gains inclusion rate is 80%. Brilliant. So we are also told that we had an assessed tax loss of 250,000 in the previous year. So an assessed tax loss is when we make a loss, right, instead of making a profit. And then we are allowed to use that loss in the following year to reduce our taxable income. And effectively means reducing our tax payable on our profits because we made a loss. All right, so here is another issue that you need to pay attention to. So sometimes we pay penalties or interest to the receiver of revenue. So in this case, the receiver of revenue charged us probably for some non-compliance. So they charged us an interest of 13,000. So what happened is that when we were paying the provisional payments after every 6 months, 31 July, 31 December, we make provisional payments. So when we made the first provisional payment, we included the 13,000 interest, but that's not a payment for provisional payment. It's for interest. It's an expense. So this is omitted because it has been included under provisional payment. It should be an expense. So it must be. It's an error that has to be corrected. It needs to be deducted from the profit before tax, right? And because this is a penalty, it's also an exempt difference. It's not deductible. It's also going to be a reconciling item, right? So we come to the concept of deferred tax, which I think many students have heard about as long back as when you started your first year. You probably I listened to students talk about deferred tax, that they have been told there's deferred tax at that level. So we just came across some deferred tax now. All right, so our deferred tax is provided for using the statement of financial position approach. So we'll explain to you what temporary differences actually are. But for an introduction, temporary differences, right? All right, I will explain to you when we come to the actual calculation of current tax. Then we will show you, we'll try to explain to you what deferred tax is. Then we have this figure here, which is a deferred tax asset balance for the previous year. All right, so remember the previous year, the tax rate was 29%. All right, so the deferred tax calculated on using a rate of 29% is this amount. All right. So that is where we are now. All right, so nice, very nice, right? It's brilliant. So now we go to the required. So the required says discuss the deferred tax implications of the administration property. So as you remember, the administration property building is exempt. We are told that SARS does not allow any tax allowances. So we're going to recognize deferred tax liability on all taxable temporary differences. So if you look at that, the carrying amount of the building will be whatever amount it is, right? Then the tax base is going to be 0 because we are not allowed. So we're going to have a difference, which is obviously the carrying amount of that, all right? But then we need to know whether to calculate the taxation on this one, all right? So they said calculate the discuss the deferred tax implications. So we know that deferred tax liability is going to be recognized for all taxable temporary differences, unless those temporary differences arise from the initial recognition of an asset in a transaction which is not a business combination, not a business combination, and which is a business combination, I forgot that. And at the time of the transaction, it affects neither accounting nor taxable profit or loss. Okay. So therefore, deferred tax in this particular case is not recognized, because when we acquired the building, we debited the building, we credited maybe bank already if we paid by cash. So this transaction here, this recognition, this initial recognition here, does not affect accounting profit. And we know that because this particular item, right, is not permissible for tax deductions, it does not affect taxable profits as well. As a result of that, we're not going to recognize deferred tax liability, because the temporary difference that arises is going to be exempt, right? Also, these are some of the things that you need to remember. When is something exempt? When is something not exempt? All right, so this is not supposed to be your notes. It's just a session which should serve as useful reminders for the things to come. Right. Then the next thing is that we are told to prepare the general journal entry for payment of provisional tax. So if you remember, the provisional tax is here. This 13,000, all right, is not provisional tax. It's an expense in the profit or loss account. Then the difference would be, is it 360,000? All right. So this 360,000 and this 180,000 are going to be provisional tax payments. So we have to debit the SARS income tax account and credit the bank, right? So if we're going to do that, interest paid is going to be debited to the profit or loss. So always pay attention, because sometimes the examiners like including the penalties within the provisional payment. So you need to exclude it. Once you exclude it here, you also need to correct the profit before tax, because this item has been omitted. And once you correct that, you remember that it's also an exempt difference and also a reconciling item. So this is now going to be our payment to SARS in the statement of financial position. This also is in the statement of financial position. This is the bank. Now, what we need to do is to calculate the correct profit before tax. So, when the examiner says we need to calculate the correct profit before tax, many students start or some students rather, and it's worryingly many students who then start adjusting this profit before tax for exempt differences, and they already think of calculating tax. But we haven't touched the taxation aspect yet. We're still doing accounting. So certain aspects, right, of these transactions has not been treated well according to our accounting standards. So we need to take care of that, right? So we've been given this profit figure. If you want to go back, it's given to us. Then this interest paid, remember that it was omitted. So it now needs to be deducted. Remember that profit on the sale of the drone, that was not recorded. We now have to add it as well. Remember that prepayment, which was altogether considered as an expense, right? We need to add back the 10,000 because it's prepaid. It was deducted. We need to reverse the effect by adding it back. So if we add back that, we have an adjusted profit before tax of that amount. All right. So that's our corrected profit before tax. We haven't used any exemptions, any exempt differences, any temporary differences. What we have done here is just to apply the accounting principles as normal. Now, when we have our adjusted profit before tax, now that's our starting point. If we want to calculate, current tax or the amount of or taxable income. All right. So from here, the next question requires us to calculate the deferred tax balance for the year ended 31 December 2020. All right. So how do we calculate a deferred tax balance? So that's going to be very easy. The principle is we need to determine the carrying amount of an asset, the tax base of an asset, then the temporary difference. All right. Then the deferred tax asset or liability. All right. So your examiners want you to what? All right. I'll explain that. I hope I won't forget because I don't want to say a lot of things. So you're going to have an asset here. Let's say plant. That is an amount of 100,000. All right. And but the tax base is 75,000. All right. So this is temporary difference. The difference between the carrying amount and the tax base is the temporary difference. The temporary difference is 25,000. Let's assume that our tax rate is 28%. Then we're going to calculate deferred tax on this temporary difference of how much is that? So it's 28%. Let me just do the calculation now. So I have 28% multiplied by 25,000. So I have 7,000. All right. 7,000. All right. So I haven't explained whether it's deductible or taxable. I haven't done that. I want to do that later after I've just done some explanations as to the layout, rather the format for calculation. Then we could have income received in advance. So remember, according to SARS, we have our income received in advance of 10,000. But according to SARS, we do not have that income received in advance does not have a tax base. And why is that the case? Because according to the gross income definition, any amount received for our use should be included in gross income. So in the future, we have no income received in advance to be included according to SARS. We have to include it now. So in the future, we don't have anything to include, right? Because the rule says include it now. But according to accounting standards, we have to include this amount in the future. All right. So when we include it in the future, we will have 10,000. But because this 10,000, we've already paid tax on it, it's going to be not taxable in the future. All right, so we're gonna get a benefit of not paying 20% on this 10,000. So we won't pay tax on what is that? 2,800. All right. Okay. All right. So that's the broad idea of how we calculate these deferred tax balances. Then we have to follow the rules, right? So these are the rules that we have to follow. If carrying amount of an asset is greater than the tax base of an asset, then the difference, then the temporary difference that you see there here is going to be a taxable temporary difference, which results in a deferred tax liability. So if you look in your first case here, the carrying amount of an asset, which we said planned, is greater than the tax base of that. So this 25,000 is going to be a taxable temporary difference. So if you could choose to show your taxable temporary difference outside brackets, and then the deductible temporary difference in the brackets, right? And which means that, so in this case, you also decided to show your deferred tax liability in bracket. So this is going to be in bracket, right? Because it's a taxable temporary difference. Why is it a taxable temporary difference? Because the carrying amount of planned is greater than the tax base of the plan. So the difference is a taxable temporary difference. And a taxable temporary difference is going to lead to a deferred tax liability, right? Then that was rule number one. Rule number two, if the carrying amount of an asset is less than the tax base of an asset, the difference is a deductible temporary difference, and it leads to a deferred tax asset. So we look at an asset, the carrying amount of an asset is less than the tax base of that asset. And so we're going to have a deductible temporary difference, which leads to a deferred tax asset. So for now, these are just rules. And I want to say to you that this issue of this concept of deferred tax is a bit difficult for many students. So if you find it elusive, then you have to keep on trying, because this is one of those topics or those concepts you read, you understand, you think you got it, and then another time you try to go back and then you just not sure what you know about the whole thing. You're so confused. That's how you learn these things. It's not going to be easy for most students. But follow these rules though. Then we go on to liabilities. If the carrying amount of a liability, right, is greater than the tax base of a liability, this leads to a deferred tax, deductible temporary difference, right, which leads to a deferred tax asset. So if you look in this case, this is the case that we have, right? We have a liability, income received in advance is a liability. It's greater than the tax base of the liability, which is 0. So this 10,000 is going to be a deductible temporary difference. And because we chose our deductible temporary differences to be shown in brackets, we're going to put this in brackets. And this is going to be a deferred tax asset outside brackets. Brilliant. So the fourth rule is carrying amount of a liability is less than the tax base of a liability. Then we're going to have a taxable temporary difference, which leads to a deferred tax liability. Right? So those are the 4 rules that you always have to keep in mind as your starting point. But of course, you must be able, by the time you reach your exams, if you're doing your semester module, that is your May, June, or October, November, this you should have cemented the understanding of these things. Right? And if you're doing your year module, you obviously well, very sorry, because then they're gonna apply this topic to every other topic you study. You're gonna study leases, they're gonna include that. You're gonna study revenue, they include deferred tax. You're gonna study non-current assets held for sale, they will include deferred tax. Whatever you think of, they will include. So it will be a bit complicated for you. Well, complicated, a bit demanding, right? I think that's fair to say, a bit demanding. All right, so all that is gonna be, that is the rules. Now, what we do is we calculate the, so let us go to the actual question. All right, so we're gonna list the assets that we have. So the assets that we have land, which is 500,000, and the tax base is 0 because land is not, there's no tax deductions. So the tax base is basically the tax deductions in the future, the amount that is going to be applicable for tax purposes in the future. And there is no amount here. Based on this original amount, there is no tax. All right. But if there's a revaluation, then we will also discuss that when we do PPE. I think that will be a better place to address a revaluation. Not so. Brilliant. And so this 500,000 difference is going to be exempt. And an exempt difference does not attract deferred tax. Right. Then we have the admin building. So what we basically do with the admin building is to calculate the carrying amount, right? And this is how the carrying amount is calculated, right? It's 5% per year for 3 years, all right? So that's our carrying. This is the cost. This is the accumulated depreciation. So then our carrying amount is 1,530. But because there is no tax allowance on this admin building, it's exempt. And an exempt difference does not attract deferred tax. That's why we have zeros here. Now we have allowance for credit losses. In our records, we have 200,000, but SARS only wants 25% of that. So what it means is that SARS is gonna allow us to deduct 25% of that in the future, right? We are going to deduct 200,000 now from our trade receivables, right? But SARS says no, you can only deduct 50,000, which is 25%. So the effect is that in our statement of financial position, right, we're gonna say trade receivables minus 200,000, right? Then we're gonna get an amount here. I don't know what amount it is. Then SARS is gonna say those trade receivables, we subtract only 50. Then we have a tax base for the trade receivables. And as you can see from here, the carrying amount is going to be less, right, than the tax base. Because when we go to trade receivables, in the statement of financial position, we're going to deduct 200,000, but SARS only deducts 50,000. So the carrying amount is going to be less because we deducted more. SARS deducted less. So the carrying amount is going to be less. So it's a case of the carrying amount of an asset which is less than the tax base of an asset. And this is the situation that we have here. The carrying amount of an asset is less than the tax base. So the difference is a deductible temporary difference, leading to a deferred tax asset. Not so. So the difference here is 150,000 is a deductible difference. It leads us to a deferred tax asset of 42,000. That is 28% multiplied by that. So your examiners want you to show here whether it's exempt, whether it's deductible, whether it's taxable. And they also want you to show the tax rate here, the rate that was used on these amounts. They want you to show it here. So this 28% there, please make sure you do show it. Your examiners also want you to show these amounts as deferred tax assets or liabilities. So we choose to show by way of brackets, right? Brilliant. So we have drones. Drones is an asset. We calculate their carrying amount, right? So the carrying amount of drones, remember there are 2, right? But now with SARS, SARS only allow, is it SARS? This is the carrying amount, right? We subtract the depreciation for 1.5 years. No, this is going to be the tax base because the carrying amount is based on 4 years, then the tax base is based on 5 years. So if we calculate this, we should be able to get our tax base of 126. Then our carrying amount is going to be 112,500. It's also given to us, but we could have calculated that and said 90,000, right, multiplied by, or divided by 4, multiplied by 2 here, because there are 2, and we only spend 1.5 years. All right, so what it means there is that we're going to get our accumulated depreciation from this calculation. 90,000 for each drone, but we have 2 drones, depreciated over 4 years, but for now it's 1.5 years that we've allocated. So 90,000 multiplied by 2, multiplied by 1.5 divided by 4 is 67,500. Is the accumulated depreciation. Then your 180,000, which is the cost of those 2, all right, less 67500, it's going to be 112,500. All right, so you should be able to calculate those things. All right, that's they're not going to be too complicated, but sometimes they can be a bit tricky. So you see, this is a case where your carrying amount of an asset is less than the carrying amount of the tax base of the asset, right? So it's a deductible difference, which leads to a deferred tax asset. So we have prepaid expenses. Now, according to SARS, if a prepaid expense is less than 100,000, it has to be deducted. So according to us, on our balance sheet, on our statement of financial position, we have 10,000. Now, I'm giving away my age when I say the balance sheet, because you guys say the statement of financial position, we say the balance sheet. We used to say that. So on our statement of financial position, we would have an asset called prepaid expenses, and that's 10,000. But SARS says no, you guys have already deducted this year. So in the future, you're not going to deduct anything on this amount. So we have an asset whose carrying amount is greater than the tax base, leading to a taxable difference and a deferred tax liability, 28% of that. So eventually now we have to add up everything. We say, okay, we are done. So what are we going to do in this column here is to add up all the temporary differences. We leave the exempt ones out. Right, so we have 150,000, right? So that's going to be 150,000. Then I'll add 13,500. So these are the amounts, this amount and that amount. Then we deduct 10,000. So we don't mix up the taxable and deductible differences. We combine those two, all right, and see which one is the bigger one. All right. But in this case, the deductible is the bigger one. So the difference here, 153,500, is a deductible temporary difference. And then the tax rate is going to give us 28% of that. So what happened here? Did I make a mistake in my calculation, or I think this amount here, is it correct? It's probably not correct. All right, sorry, it is correct. If it is not correct, let me just cross-check together with you here. So 42,000, yeah, because then in typing I could make mistakes there, and I'm very sorry. I don't want to make mistakes. That's 2,800. So I get 42980. My apologies for that one. All right, so that's our deferred tax asset. Brilliant. Now, all right, so that's now this position here, this temporary difference is a deductible temporary difference. All right, so what do we do when we're calculating what is this current tax? We do not just need this figure, we need the change from the previous year to the current year. So we need the temporary differences for last year. All right. Then we need temporary differences this year. All right. Then we look at the difference between those two, or rather, in other words, the movement in temporary differences. All right, so that's the amount that we use to calculate taxable income, not the actual balance, but the movement from last year to this current year. So, which means that we have the balance for this current year. So the balance for the current year, let's say last year. So current year, we given that is 153,500, right? So it's 153,500. Not so. But last year we have to calculate because we are told that, so if we come here, we are told that there was a deferred tax asset of 107,083. All right. So as you know, a deferred tax asset, we can only get it after saying the tax rate, which is 29%, multiplied by some temporary difference. It's going to give us 107,083. All right. So that deductible is going to be deductible temporary difference because it gave us the final result as a deferred tax asset. So it has to be a deductible temporary difference. I'll explain to you what deductible and taxable mean and how do we treat them. All right, so there is where we are. So it's 107,083. We divide that by 29%. So if I do that, I get my balance for last year. Where is it? Is it here? All right, my balance for last year. Where am I? All right, so it's gonna be 369,252. All right, so this was a deductible temporary difference. This is still a deductible temporary difference, but as you can see, there's been a decline because the deductible temporary difference last year was higher than this year. So there's been a decrease, all right, in a deductible temporary difference. So the decrease amounts to the movement also, of course. Okay, so that's the movement in temporary difference amounts to 369,252 less 153,500. So the movement is 215,752. So calculating the movement has been easy because it has been easy, right? Because we have temporary, we have deductible temporary differences in both cases. So it's just the difference between both of them, the difference between those two. So this is the movement in temporary differences. But we need to know whether this movement is taxable or deductible. And here are the rules for us to know whether this movement is taxable or deductible. But the movement we did calculate, but now we need to know whether it's taxable or deductible. Then from there, we need to know if it is taxable, what do we do with it in calculating taxable income? If the movement in temporary differences is deductible, what do we do with it? But for now, we need to determine whether it's taxable or deductible. All right. So here are the rules that you need to follow. An increase in deductible temporary differences is a movement, all right, which results in an increase in deductible temporary differences. That movement is going to be deductible, right? And after we determine based on these rules, then we will have to determine how do we treat those. If it is deductible, it is taxable. What are we going to do with that? So if there's been a decrease in deductible temporary differences, then that decrease is taxable. So for now, I'd like you to take these as rules because we don't have the time to have 3 hours and it will be information overload, right? Some of these things will become clearer as you practice. And if you need more practice, you can always ask us. We'll be able to help you in our groups. So if the movement, if there's an increase, if the movement results in an increase in the taxable temporary differences, then the movement is taxable. And if it results in a decrease in taxable temporary differences, then the movement is deductible. So our movement fits category 2, all right, where there's been a decrease in deductible temporary differences. We're coming from 316, we now somewhere around 153, if you remember that. So it's a decrease, right, in that's going to be a decrease, all right. It's decreased by 215. So this 215,752 is a taxable temporary difference. Why is it taxable? Because it's a decrease in deductible temporary differences balanced from one year to the next, based on these rules that we gave you here. All right. So if you find it a little bit confusing, that's how the information is going to percolate into your mind and your memory and your thinking faculties. So do not worry. You can go through this recording as many times as you want. You can come to us and ask us for any clarity, and we will clarify for you. But over time, you will bamba all these things, right? You will bamba them. Right, so now let's go to the next question. The next question says, calculate the current tax due to the South Africa Revenue Service. So the current tax due, will explain to you how we calculate it, but we start by calculating current tax. Then we also adjust that current tax for the due part. Then, okay, so we're gonna do the calculation. Remember that our adjusted profit before tax, after all the adjustments, this is where we are. Not so. Brilliant. So we're going to start from the profit before tax is that amount. Then the first thing is that, okay, now what we need is to calculate tax. So we're going to apply the rules of SARS. So the first focus is the exempt differences. So these exempt differences refer to items included in the profit or loss in the income statement, all right? But for tax purposes, we need to remove them. So those are the exempt differences. That's our first focus. So the foreign income, we're going to remove it because it was added. We have to reverse the effect. So all income items are going to be deducted, right? And all expenses are going to be added back. That is to say, all exempt income items, all exempt expenses have to be added back. In other words, we are reversing them because they should not be included for the purposes of calculating taxation. But for our accounting, they should be there. But for now, we need to calculate the current tax due. So we need to do those adjustments. So foreign income, we were told it's not taxable. So we deduct it, right? Dividends, we know that they are not taxable. We deduct them. Then the capital profit, that portion above, this is the selling price, this is the cost. Then 20% of that is going to be exempt. So because that profit was included in the profit before tax, we reverse it by subtracting it. Then the fine from Metropolis, we are not allowed to deduct that. So we have to add it back to the profit. Then the interest paid with the provisional tax, we're not allowed to deduct. We add it back. Then the depreciation for the administration building, remember that it's what? It's exempt, right? Because no tax allowances are allowed. So we're also not allowed to deduct the depreciation so that it will reduce our taxable income, right? So we have to add back the 90,000. So the net effect of all these adjustments is that we have to adjust, we have to deduct our profit before tax by 192. If you say 200 plus 100 plus this, then the net effect is negative 192,000. So 2.5 minus 192, we get this amount here, 2308. Right? So this amount is called, you can say, taxable income before movement in before temporary differences, or you can say that's taxable income after exempt differences, or you can leave it as it is. Then remember, we have this movement in temporary differences, and we said it's taxable, right? And we said this is the amount, right? So it's taxable, and we said this is the amount. So how do you deal with taxable? So if it is taxable, if the movement in temporary differences is taxable, right? What that means is, so that can be confusing, but I want you to listen very carefully. So what that means is, if the movement is taxable, based on those rules that we discussed, if you find it to be taxable, the movement from last year to this year, if you find that movement is taxable, then what you need to do is to deduct it from this figure. Because the movement is taxable, you need to deduct it. So taxable difference means SARS does not want us to pay tax today. It's taxable in the future. So for the purposes of paying tax, this amount should be removed from the taxable income, right? Because it's taxable in the future. That is what it means, right? When we say it's a taxable temporary difference, we're going to pay tax in the future. But so when we calculate current tax, remember, current tax is what we pay to SARS today, this year. So when we want to determine that amount, we are told by SARS rules that you can pay this amount in the future. So we have to deduct it from this amount. So it means that then our taxable income is going to be this amount here. So if this was deductible, if this movement in temporary differences was deductible, it means it's deductible in the future, all right? In other words, we have to pay tax now, and it's a prepayment for taxation. In the future, we can just deduct that prepayment. So if a movement in temporary differences is deductible, right, it means when we're calculating current tax here, we have to add it, because SARS wants us to pay tax now, then we can deduct it, that prepaid tax in the future. That's why we call it deductible. We're looking at the future and say, how is it going to affect our taxation? We're going to deduct that in the future. So deductible means we have to pay the tax now. So if the movement in temporary differences is deductible, we add it. Taxable means we will pay tax in the future, so we deduct that. Brilliant. So now we have our taxable income, and we apply our tax rate. This is our current tax. But the question says calculate the current tax due. All right. So due is different from the current tax. Or it could be calculate the current tax liability, or calculate the current tax due. That is the amount still unpaid, which has to be paid to SARS. So the amount to pay to SARS, you have to subtract the provisional payments, which is 540. But remember that 13,000 was not a provisional payment. It was a penalty. So what still has to be paid is the difference between the current tax expense and the provisional payments made. So this is the amount. Right? Brilliant. So from there, I hope this does make sense to you. I'm trying my best to explain. But like I said, you're welcome to ask me, because this is my explanation. So you're also welcome to correct me there, please. Because, if you talk a lot for over an hour, you sometimes don't know what you immediately said. You say something and it's wrong, or you could actually believe. Well, it's possible that you know and then you don't. And that would be very regrettable anyway, but it does happen. Right, so we have the current tax. Now we need to do the tax rate reconciliation. But before we do the tax rate, we need to do the disclosure. So when the question says we must disclose the income tax expense note, we have to include the tax rate reconciliation unless specifically instructed, right? So this question says we must exclude it because the income tax expense note has to include the, what is it? Has to include the tax rate reconciliation. It's part of the income tax expense note. So if they don't tell you, please always include it. But as far as I know, they will always tell you, right? They will always inform you. So this is how you disclose your tax, the name of the entity, the year, Then the note being the note that you disclosing. So the major components, so you're now breaking down the tax expense, the major components of tax. All right. So your current tax expense, we calculated for the current year, we have calculated, right? The amount we calculated is the current year. This is the amount. If you remember, that's what we got here. 585829. 585829. Then if there was an over provision last year, we have to deduct it here. If there was an under provision last year, we have to add it here. And then together, these two are going to give us the current tax expense. Right. Then we come to deferred tax. So the movement in temporary differences, remember that amount, which was 215, we already did calculate the movement. All right. Because it's deductible, it was taxable. All right. It means if it is taxable, it means we have to pay tax in the future. So it's a liability, right? But for that liability, we have to recognize the tax expense now. Because the liability is going to be paid in the future, but the tax expense has to be recognized now. So 28% of this is going to be an deferred tax expense. So movement in temporary differences, this 28% of that is going to be an expense now, because we have to raise a deferred tax liability from the taxable temporary difference. So we debit the tax expense, we credit the tax liability. Right. If it was deductible, then it was going to be in brackets, because we have made a payment today for items that arise next year. So we have made a prepayment. So when you disclose a prepayment, you deduct, rather when you disclose an expense, you deduct the prepayment. All right. Then there's a rate change. So previously we calculated our deferred tax at 29% last year, right? 29%, and we had an asset worth 107,083. But if we use 28% now, because the rate has changed, our asset is going to be smaller, because it was 29% of some amount, which gave us this. But because the tax rate has changed, we now have to use 20%, 28% of that amount. And the asset is going to be smaller. So when an asset is reduced in value, that's an expense. So we have a rate change expense. This amount is an expense. So if you combine those two together, then you get the deferred tax expense. So this is the current tax expense, the deferred tax expense. And then foreign tax, we are told that it's being paid at 15%. So which means the foreign tax we paid is 30. So together we have current tax plus deferred tax plus foreign tax. And this is the income tax expense, right, that we have in our income statement. So we have a profit before tax, 2,500,000. Then income tax expense is 679,932. Not so. Then we have to do a tax rate reconciliation. We have to show what happened, because the users of financial statements, when we say profit before tax 2.5, then immediately below that income tax, they think that the income tax is going to be 28% of this. So the users are expecting 700,000. Now this accounting standard requires a reconciliation. What happened that it's not 700,000? The income tax expense is 67932. Why is it not 700,000? So we have to explain, okay, you see this 2.5, ne? Right? Basically, this 2.5, there's an amount of 200,000 there, which was added to that amount. But now SARS says, no, remove that amount. So we removed that amount, right? And we paid tax as 15%, which is 30,000, instead of paying tax of 28%. All right. So that's the effect of foreign tax. So you can basically say 15% minus 28% of the amount. All right. You can put it in one line. I just drew it in 2 lines. All right. So because Namibia charged us 15%, we benefited. All right. That is why we ended up paying less tax. So, all right. So that is the adjustment that we have. All right. Then we also explained to the users to say, we know what you will, in this 2.5, there is dividends of 100,000. SARS said to us, remove them. So removing those dividends resulted in tax going down by 28% of 100,000, which was removed. And we said there were also capital profits. SARS said remove the 1,000 rand. So removing that 1,000 rand resulted in tax going down by 28% of that 1,000. But SARS also said you must add back this 19,000 to the profit before tax. So adding it back resulted in an increase in taxation of this amount. There is then there's depreciation on administration building. SARS also said don't deduct it, add it back. So that resulted in an increase in taxation of 25,200. And because there was a rate change, our tax increased by, tax position became more expensive by 3,693. In other words, we lost an asset by a value of 3,693 because we had a tax asset at a certain value, but now the value has been reduced. So a reduction in the value of an asset is an expense. Brilliant. So that's how we ended up paying 20,068 less, which is this amount. Then because there is a rate change, you also have to include this narrative to say, basically, there was a rate change from this amount to that amount. Brilliant. So I know there has been a lot covered in one session, all right? But you guys are big. You guys are big boys and girls. And you will go through this again if you have a challenge. Then if you have questions, you can ask us, right? We will be able to assist you if you want to understand anything. Right, so that was it for the session that we had today. Good luck in your studies. I'm signing off.